Friends, welcome back to our channel OMSAI Bhojanapalli.
Stop talking. See, I am going to invest 50% in X, 50% in Y. That means I am investing in a single security, a portfolio of security, a portfolio of security. How a single security can have a return and risk, so too what a portfolio can have a return and risk. That is what we call as sigma P is what standard deviation of the portfolio. Sigma P the square, whole square gives you what? Variance of the portfolio. Respond yes or no? Can I start or not? No. Let's go from known to unknown. Okay, now. We all know how to calculate standard deviation of a portfolio having two securities. Yes or no? Same here. Can you tell me the formula? Sigma P is equal to what? Wx square, sigma x square, Wy square, sigma y square plus 2 into Wx into Wy into sigma x into sigma y into. When I take what? Square root. When I say variance, it is sigma p squared. Yes or no? It is the variance of a portfolio. It is the variance of what? Portfolio. Now, they ask you to find out the portfolio variance in this question now. Now, this is one formula for finding out what? Variance of portfolio. But can I use this formula or not? No. Because the question has not given me correlation between security. If the question gives me correlation between security, I need not go to sharp and dull. I can go for what? First stage, both will give what? Same answer only. Since I don't know the correlation of the security, I cannot use this formula to find out what? The portfolio standard deviation. Enough, yes or no? I cannot find out portfolio variance or portfolio standard deviation using the original formula. This is correct formula, I don't deny it, but I don't have a data because I don't have a data of what? Correlation of X and Y. So this formula I cannot use. This is a right formula I cannot use due to what? Non-availability of data of correlation of X and Y. Yes or no? Still, without knowing correlation between two securities, I can still find out risk of the security. That is what I want to discuss now. Without knowing what? Correlation between what? Two securities, I can still find out what? The standard deviation of the portfolio consisting of these two securities. Sharp has given that formula. Everybody follow what I am saying? So, when I say what is sharp contribution? Very simple here. If I have some portfolio consisting of what? Some securities, then we should know the correlation between what? All the securities. 100 securities means what? 100 correlation. It may be very difficult to calculate, yes or no? But Sharp, through his Sharp index model, is now helping us to calculate what? Even a portfolio standard deviation without knowing what? Correlation among individual securities. Are you follow what I am saying? So now let us see what is the other formula for finding out the portfolio risk. Yes or no? Now, let us go from known to unknown. V is equal to what? Beta squared sigma m squared plus sigma ei squared. Yes or no? Any correct? No. This is what? Variance of a security is the following formula. Now, suppose I want to know the variance of security X. I want to know variance of security X. What is it? Variance of X is equal to what? Beta of X square with what? Sigma M square plus sigma EX square. Yes or no? I want to know the variance of individual security what? Y. What is variance of Y? Beta of Y square plus sigma M square plus sigma EY square. Yes or no? Now, how individual securities can have variation? Nothing but a standard deviation square. I can also find the variance of portfolio or not. What is variance of portfolio? Variance of portfolio is equal to beta P square into sigma M square plus sigma EP square. You know what I am saying? Now, this is what I am going to elaborate now. Can I proceed or not? Now, how a security variance can be found out using this formula? I can use this formula to find out what? Variance of a portfolio also. How to find out is the issue? Everybody, yes or no? Now, this formula summarily, understand what I am saying? How security X variances beta of the security into what? Variance of market. Security Y squared is what? Beta of Y into what? Variance of market. Like that, variance of portfolio is what? It's not beta of X. It's not a beta of Y. It's a beta of what? Portfolio. What is a portfolio beta? Weighted average beta of the individual securities. Respond yes or no? So can I elaborate the formula now? Let's look at the formula now, please. Variance of a portfolio is equal to, can I say, beta portfolio, standard deviation portfolio, the whole square, sigma EP square. Right or not? Let's elaborate one by one the term. Let's go forward. First term. What is beta portfolio? Wx beta x plus Wy beta y. Yes or no? Can I say like this? It is VM portfolio is equal to Wx beta x plus Wy 2 secondary portfolio. What? The whole square into sigma m square is the systematic risk of the portfolio. Agreed or not? Correct or no? I should know the unsystematic risk portion or not? Plus. What is unsystematic risk? The first portion, or you'll follow what I'm saying. What is Wx plus beta x plus Wy beta y? Portfolio beta square into what? Market variance. The portfolio beta variance into what? Market variance gives you the systematic portion. Yes or no? I have to go for what? Unsystematic risk. Now, portfolio error consists of error of x alone, error of y alone, x and y in the proportion wx and wy. Yes or no? It is very simple. Plus Wx square sigma Ex square, that is weight of x into what? Error of x, Wx square plus sigma Ex square plus what? Wy square sigma Ey square. That's all. Are you saying? Now, sir, what happens to correlation? There's no correlation. I'll discuss about that later. This formula does not have what? Any correlation. We'll have a more elaborate discussion after we complete the sum now. Are you follow what I'm saying? Now, this is the variance of a portfolio. Tell me, what is the variance of a portfolio? Tell me, two securities, x and y. Tell me the formula. Beta x, Wx beta x plus Wy beta y, the whole square. Nothing but what? Beta p square into what? Sigma m square plus Ex square is also there, Ey square is also there. And what proportion? Wx, Wy, no? Wx square, Ex square plus what? Wy square, Ey square. Don't ask that what happens to 2 into Wx into Ex into Wy into Ey into what? Correlation. I'll explain that term later. It will be absent here. Are you follow what I'm saying? We'll have the explanation separately. This is the formula for what? The variance of a portfolio. Yes or no? No. Please tell me, there are three portfolio, three securities in what portfolio? X, Y and what? Z. Tell me what is the formula? Wx beta x plus Wy beta y plus Wz beta z, the whole square into what? Sigma m square plus what? Wx square sigma Ex square plus Wy square sigma Ey square plus Wz square sigma Ez square. Very simple than the original formula. Yes or no? Tell me, I have A, B, C, D. For example, last year, okay, don't get confused. A, B, C, D. Just to confirm, in exam, 6 security portfolio ask you to find out this particular variance. Yeah, one of the exam problem. Can I say? Now, yeah, how many securities? Yeah, 4 securities. A, B, C, and what? D. Tell me what is portfolio variance? Variance portfolio is equal to what? WA square beta A square plus WB square beta B square plus WC square beta C square plus WD square beta D. Sorry. Out of form. WA beta A plus WB beta B plus WC beta C plus WD beta D gives you a portfolio beta, the whole square into what? Sigma M square plus what? WA square sigma EA square, WB square sigma EB square, WC square sigma EC square, WD square sigma ED square gives you the portfolio variance. In calculating all this, do I require n square terms and all? Not at all. Then we have to have correlation between x and y, x and z, y and z, 2 times. All those need not be calculated in the sharp single index model. Everybody are you following what I am saying? So this is the way in which one should calculate what? The portfolio risk using the sharp single index model. If you don't have a standard correlation between the two security, this you can use to find out what? The variance of a portfolio variance of a portfolio of securities. Everybody, are you understanding it or not? Can we complete this sum? After I complete, I have more discussion about this formula and sharp single index itself. That is going to be the last stage of discussion before I wind up this particular segment. Everybody, are you following or not? So write down. Up to what you written? Step 2. Step 2 or step 3? Step 2. Write down step 3. Now write down step 3. Please. Variance of a portfolio consisting of variance of the portfolio consisting of equal proportion of variance of portfolio consisting of equal proportion of what? X and Y. Variance of portfolio consisting of equal proportion of X and Y. Equal proportion of X and Y. Underline that. Write down. In sharp index, the portfolio variance is calculated as follows. In sharp index, the portfolio variance is calculated as follows. The portfolio variance is calculated as follows. Write the formula. Variance of portfolio is equal to let's write one by one. Beta P sigma M the whole square. Beta of portfolio standard deviation of portfolio the whole square. Variance I square it. Beta P sigma M whole square plus what? Sigma EP square. Plus sigma EP square. The first level of writing the formula is or no? Plus sigma EP square. Can I put or not? Now break it further. Variance of portfolio is equal to I want an answer. What is beta of portfolio? Weighted average. So variance of portfolio is equal to WX beta X. Variance of portfolio is equal to WX beta X plus WY beta Y. Variance of portfolio is equal to WX beta X plus WY beta Y the whole square. Then beta portfolio squared na the whole square into what? Sigma M square into sigma M square. Tell me this whole term will be called as what? Systematic risk of the portfolio plus WX square plus WX square sigma EX square. That's error of X, okay? WX square sigma EX square plus 1 WY square sigma EY square. WX square sigma EX square plus WY square sigma EY square. Can I proceed or not? I don't. Next. This can be further understood as follows. Systematic risk is equal to beta P squared sigma M squared. Systematic risk is equal to beta P squared sigma M squared. Accept or not? What is beta P? Break it into WX beta X plus W2 beta Y. These are systematic risk portion. Beta P square plus the sigma M square. Next is what? Unsystematic risk is equal to WX squared unsystematic risk of X. WX squared unsystematic risk of X. What is unsystematic risk of X here? Sigma EX squared. No? So WX squared plus unsystematic risk of X plus what? WY squared into unsystematic risk of what? Y. WX squared into unsystematic risk of X plus WY squared into unsystematic risk of Y. We all know what is unsystematic of X here? Sigma EX squared. Unsystematic risk of Y here? Sigma EY squared. Response is or no? Understood? So it is WX squared unsystematic risk of X. Either we call as what? Unsystematic risk of X, which we call as what? Unsystematic risk of Y. So the weight of the security squared into its unsystematic risk, the weight of other security squared into what? Its unsystematic risk is going to give you the unsystematic risk portion. Everybody, are you following or not? Now let's substitute the numbers in this problem. The portfolio variance is as follows. In this problem, the portfolio variance is as follows. In this problem, the portfolio variance is as follows. Can I proceed or not? Write down. Systematic risk. Systematic risk. What is the proportion of x and y? Can you tell me? 0.5, 0.5. So it is going to be 0.5 into 0.5 into, what is beta of x here? 0.71. 0.5 into 0.71 plus 0.5 into 0.71 plus 0.5 into 0.685, 0.5 into 0.71 plus 0.5 into 0.685, the whole square into, what the variance of market? 2.25. Systematic risk is 0.5 into 0.71 plus 0.5 into 0.685, the whole square into 2.25. Please tell me the simplified number. What is the portfolio beta? 0.5 into 0.71 plus 0.5 into 0.685. Tell me the beta. Yeah? What is the portfolio beta? So, what is the portfolio beta? 0.5 into 0.71 plus 0.5 into 0.685. What is the portfolio beta? Ba? Correct சொல்லுப்பா. 0.5 into 0.71 plus 0.5 into 0.685. என்னமா நம்பர்? எப்படியா வரும்? 0.4868. A simple average. Yeah, 0.697 0.675 squared. என்ன புரிஞ்சாப்பா? Into 2.25. கேட்ட நம்பரை சொல்லியா? 0.697 squared into what? 2.25. Tell me the number. Point? என்ன ஏதாவது ஒரு நம்பர் கடை. வாட் இஸ் நம்பர் யா? 0.6975 into 0.6975 into 2.25. What's the number? 1.09. Leave it here. 1.095. Yes or no? உனக்கு ஒரு ஒர்க் கொடுத்தா how much you are confusing? 1.095. Can I proceed? Now, next. Unsystematic risk. Unsystematic risk. 0.5 squared, WX squared na 0.5 square. You found out the unsystematic risk of the security X earlier, no? How much is going to be? 5.166. என்னையா முன்னாடி பாத்தியாப்பா? So 0.5 squared into what? 5.166. Where you got this 5.166? Step 1, go and see. I found an unsystematic risk of X or not? 5.166. Don't square it. That itself is what? The unsystematic is fully. Okay. So the proportion of security is squared into what? It's unsystematic risk plus. Next is what? 0.5 squared. I want everybody to tell me what is the unsystematic risk of security Y. How am I going to be? 4.804. 4.804. You simplify everything and tell me 0.5 squared into 5.166 plus 0.5 squared into 4.804. What is the number here? 2.4925. 2.4925 is 2.4925. Can I proceed? Now, write down total risk. Total risk is equal to systematic risk plus what? Unsystematic risk. Add and tell me 1.095 plus 2.4925. What is the total risk here? 3.58. 3.5875. This is the variance of the portfolio. 3.5875 is the portfolio variance. Write down. The portfolio variance is, please, the portfolio variance is 3.5875. The portfolio variance is 3.5875. And portfolio standard deviation is, sigma p is equal to square root of 3.5875. Portfolio standard deviation is sigma p is equal to square root of 3.5875. Square root of 3.5875. I want an answer. What is the number? 1%? 1.8941. 1.8941. Standard deviation is 1.8941. 1.8941. என்னப்பா ரெஸ்பான்ஸ்? எஸ் ஆர் நோ? பயமா இருக்கியா? I mean, look at you. Now, tell me, formula, I leave you now. First of all, I'll ask you all the formulas. Tell me, first of all, we'll go from reverse. What is the variance of a portfolio. What is variance of a portfolio? Wx beta x the whole square into sigma m square plus what? Wx squared into unsystematic risk of x plus wy squared into unsystematic risk of y. Don't pack. Please listen. Are you following or not? Please. I am discussing for you. Right or not? Next. What is the variance of a security? What is the variance of security? V is equal to beta square sigma m square plus sigma ei square. Beta square sigma m square is called as what? Systematic risk. And sigma square is called as what? Unsystematic risk. What is the return of a security? Ri is equal to what? Alpha plus beta rm plus ei. What is error term? Difference between the actual point and the regress point. What is coefficient of determination? Systematic risk divided by unsystematic risk. If divided by total risk. If COD is 8%, what is the meaning of that here? 8% of the risk can be explained. 92% remains what? Unexplained. Please. Next. This beta alpha should be founded or not? You may found using what equation? Regression equation. What the equation for regression here? Sigma y is equal to n alpha plus beta sigma x. Sigma xy is equal to alpha sigma x plus beta sigma x square. If I solve, I get what? Alpha and beta. From that we get a characteristic market line. What is the line here? Alpha plus beta rm plus ei. There are other formulas also for beta which has been discussed. In a summary of the discussion in the sharp singleness model, yes or no? No. One small issue is pending. I'll discuss in the next slot and then start with the APT, arbitrage pricing theory, the last slot. Okay, now. Few more observations in the sharp single index we have to discuss. 3 or 4 points are remaining. Nothing problem related, but observation from the aforesaid model. Once we complete that, we'll discuss one problem regarding Sharpe's optimum portfolio construction. That problem is once again a study material problem. It is formula based. We have a standard formula for doing it. Just you have to by heart and do that particular sum. That's all. Nothing more conceptual needs to be discussed there. It is a model given by Sharpe to construct an optimum portfolio. Once we complete that, we'll have an introduction to arbitrage pricing theory in today's class. Next class, we'll complete the portfolio chapter by discussing the problems in arbitrage pricing theory. Stop talking, please. Then we'll be moving on to the capital budgeting area where we'll be discussing leasing. So the technical part will be over in today's class and the next class. So you don't have too much statistics involved except when we reach derivatives wherein options and futures a little bit mathematics or statistics may be involved. Apart from that, the remaining are straightforward, easy, simple financial management chapters only. Now, just to show the importance of discussion, how we discuss in depth with all statistics, don't think that it may not be required for us or it is not required for the examination. One example is question number, that is page number 212. If we take the workbook, page 212 or 211, there was a problem given, question number 7. It is a practice problem segment given, page 211, question number 7. That was one of the examination problem. It is one of the examination problem where they asked so many questions. Securities, 6 securities have been given. Please, 6 securities are given. That the expected return, meaning of what? Mean return given. Beta of those securities given and standard deviation given. Have you all taken that page or not? Just to get the feel I am saying, please. 6 securities, their average return or expected return, their betas and their standard deviation are given. Please. They said discovery rate is 4%, market return is 6%, Standard deviation is 10% for market. That is sigma m is 10%. You are required to compute. They ask you so many things. Which security is undervalued or overvalued? Just tell me. To find out undervaluation or overvaluation, you should what model? CAPM. So every security find out K is equal to RF plus beta into RM minus RF. That is required KE. Compare with what? Expected return. You understand undervaluation or overvaluation. If you want, you can even refer alpha and then the answer based on under or overvaluation. Right or not? That is one question. Second question, assuming that the funds are equally invested in the 6 stocks, compute the return of the portfolio. Very simple. If I invest all the 6 shares equally, the return of the portfolio is what? Weighted average. In this case, even simple average because the weights are what? Same. And all the return divided by 6. I'll be getting the answer. Expected return. Right or not? Now, look at the next question. Risk of the portfolio. That's what I'm saying. Now, the risk of the portfolio can be expressed in beta as well as what? Standard deviation. In this problem, they calculated the standard deviation of risk of the portfolio. Portfolio standard deviation, when you want to calculate sigma b with 6 securities, you'll be having n squared term, 36 terms. What 36 terms? Yeah? N variance terms and n into n minus 1 covariance terms. For that, require what? Correlation coefficient. Right or not? But is there any correlation coefficient given? No. They ask you to find out what? The portfolio risk or the variance of the portfolio. How can we do that? That has been done using the sharp single index model. I given you a solution in the back side. How it has been found out? We found out no variance of a portfolio. Tell me what the formula for variance of portfolio? It is beta of the portfolio into variance of the market plus W1 squared sigma EI1 square plus what? W2 square sigma E2 square plus W3 square sigma E3 square up to sigma S. Yes or no? In that case, like this, they have found out what? The standard deviation of the portfolio using the sharp single index model. Everybody following up? Now, I'll tell you how much prepared you should be in the examination. Unless you know the full chapter in graph, out of so many questions, a dividend policy question will come, a leasing question will come, IFM, forex question will come, you may having a question from futures, a question from what? Options, a merger, so many chapters, bond, so many questions will come or not? In the midst of all the questions, this question also will what? Come. To answer this question, we should know CAPM, we should know what? Sharp single index model, everything should be known pakka. Are you following what I am saying? Now, why this subject is felt difficult is, this subject is really vast. The subject is what? Really vast. I can say portfolio which we are discussing is a subject in itself. Are you following? I am only summarizing and discussing the entire portfolio. Only what? Summarizing and discussing. That it will take what? So many hours to discuss. Everybody understood or not? Now, that is why I say you should be 100% prepared for the examination. Days are now becoming past where old dividend policy, some easy sum or what, some capital budgeting, you will be having cash flow estimation, no, initial cash flow, operating, you just add PAT, add depreciation, all those you are doing or not. So like that it was old. In our workbook, I will never deal with those sums in what? Capital budgeting, which I believe should be known at what? Intermediate level. Yes or no? Now we are dealing purely with what? Markets. I say the subject is somewhat very new to you for a CA syllabus because two reasons. We don't focus on statistics and mathematics at what? CPT level, which all the other courses students does. Because for them, economics as well as what? Statistics is a very, very important subject in the CFA level 1. Are you following what I am saying? But here we don't focus on all those. We come to what? Final, even without knowing time value of money. But the question paper is not like that. They are now starting to test what? In-depth the questions. There is no other way out. Again, I say, you may think SAR is stating lot of statistics. Why can't you do the chapters what? Easily? Why can't you have a formula discussion what? Done. It is not possible. I mean, it is not what? Possible. Syllabus level is what? Increasing. Question level is what? Increasing. We should understand subject as it should be. Everybody following up. Now, so whether you like it or not, whether you feel comfortable or not, you have no other option. To clear CA, SFM should be clear. To To clear SFM, like this, one should go for what? Preparation. You're feeling uncomfortable, go home and what? Sit. Think deeply and then try to visualize. Yeah, apart from laziness, nothing can prevent you. Everybody, are you following not? So everything is very important, and whatever single word I have dictated, how many notes I have dictated or not, these notes I can easily type and give it. In the notes giving, I can easily what? Type and give it. For me also lot of energy is saved. But I am doing specifically because two reasons here. I discuss first. At that time, your understanding level may be 30% or what? 40%. When you dictate notes, you will be regrouping what is happening. You will write in your hand what is being discussed. More clarity will be obtained. I am literally doing a second revision through what? Notes. After this day, if I am feeling what? So much load up. The third revision will be done what? On your own in the house, where you should be reading every notes letter by letter and the understanding it. Everybody, are you following or not? Now, I can say our notebook is better than most of the locally published textbook, I am saying, because everything sequentially, cogently, with numbers, everything has been what? Given pakka. One or two issues alone, I may give as printed notes, which may not be requiring so much discussion. It is too long to what? Dictate. Otherwise, we see sharp singleness itself, stage by stage. We started with what? Beta. What are all the ways of calculating? Beta. Then we had two beta formulas. We proved both are what? Same. Using what? Derivation. Then we understood what is correlation, what is regression. Notebook like we plotted points and saw how it is not in straight line, how it is scattered. Further, what is the regression equation? In that equation, what is the meaning of alpha? Then what is an error term meaning? We discussed. Then in that case, error when it will be 0. Summation of error is going to be what? 0. How it represents what? Unsystematic risk. How it is going to happening for what? Portfolio. Now we see the build-up is what? Very systematic and is also very deep. Are you following what I am saying? I can challenge that with this depth, if you prepare every chapter, this question paper will not be difficult. This question paper will not be what? Difficult. If you think that it is one of the subject and then let me just go through past RTPs, some sums here and there, let me by heart theory and what? Past means it was happening. It was happening. I am not saying due to this 3% result here, it is not so. Past 3 or 4 attempts itself, the question paper pattern is what? Changing. It is more derivative based, it is more portfolio based, it is more bond based, it is more forex based. The capital budgeting problem also that may be asked is not purely traditional area. There also what? Hiller's model, etc. are being what? Tested. The entire syllabus focus is what? Changing, and we should also change ourselves in a return. And one more thing, you understand that when you clear with taxation or with accountancy alone, you cannot survive, because those two are only limited practicing, what I say, opportunities available, right or not? Whole business is all about finance only. If you want to go for employment in banking sector, you want to go for employment in what? Equity research firm, everywhere, these things should be necessarily learned. In campus also becomes what? Very difficult. Make some effort to study the subject with what? Sincerity. Statistics, allergic, now don't worry. Even standard deviation, covariance, I discussed or not. I did not say anything, you already know covariance, so I did not say skip that. Yeah, any minimum statistics basic that is required has been discussed elaborately in the classroom, right or not? No. Why I am saying all this lecture now is that we are going to complete the chapter. If we leave this as it is for 1 week, it will become new chapter. You can go home and revise forex. I only direct quote, indirect quote. 1 by direct is equal to indirect. 1 by direct is equal to what? Direct quote. Money market also is what? Very simple common sense logic only. There is nothing so great which I learned in what? Forex. Except when you come for the derivative segment later. Are you following not? But out of all the chapter, this chapter is what? Very unique, because every word requires what? Visualization. We have built up this chapter systematically into a very big chapter. Notebook class, so many pages should have been written for what? Portfolio alone. Are you following not? This chapter, if you forget to revise this week, I am not saying this month, I am saying what? This week, if you don't revise and consolidate, you can come and attend next batch. Because you will. Don't, I'm not joking, you will totally, that is, I'm saying those are writing exam later, yeah, okay. Others, everybody should be passing. I'm saying only that's for the sake of saying it, yeah. you will forget this chapter. I'll just say you'll be forgetting this chapter, not cursing. I'm saying only what? Nature of that chapter. So now tell me, will you all go home and revise or not? Yes, sir. Remember, risk return profile, Markov. How long we have traveled here? We started with what? Risk return profile, portfolio risk and return, Markov weights, then came a CAL, then we went to what? A CML, then come to what? SML. In that itself, beta, levered beta, unlevered beta, proxy beta, portfolio beta, underpricing, overpricing. Then we jump to what? The sharp single index model. Then we had characteristic market line, still not yet over. After this, APT also is what? Present. It is a big chapter. It is what? A big chapter. It is a subject which I try to summarize in what? A few number of problems. Understand that? Are you following not? Now, examiner is like a terrorist. Anywhere, any book, question can be what? Raised and asked. So for them, doesn't matter whether they discuss in study material or not, or they giving you clarity or not. They have problems to pick from. They have what? Question to ask. You should be prepared. Are you following or not? No. And this chapter, I can say, is having an impact in futures. It's going to have an impact in what? Futures chapter later. It is going to have an impact in capital budgeting also under Hiller's model, etc. We cannot escape portfolio like that. It is a independently asked chapter for a number of marks. It is also going to gain what? Link to the other chapters. Bond beta, one problem has been asked in the current examination. Once I do some number of chapters, I'll also discuss one of the problems in the current examination to show how answers can be very simple if you study systematically the entire chapter. Everybody, can I proceed or not? No. So, I want to discuss few more points in this. So, what I wanted to show is this question number 7 is an examination sum or not? This sum requires understanding of sharp single index model, portfolio risk calculation. Without that, the problem cannot be done. Obviously, there's a mistake in the solution, and we have also gave our solution also, which has been given in a blog, that is in a bold letters. It has been given. You can refer the solution later. I don't want to spend time on that. I just wanted to highlight it. Can I proceed up? Now, next. See, 3 points I wanted to highlight before I wind up the sharp single index model. First of all, Ri is equal to, tell me, Ri is equal to what? Alpha plus beta Rm. Okay. This is regress return, actual return, actual return. Return of JK Limited share in first year is nothing but alpha 18.93 plus 0.15 times return of market in the first year. This will give you the point on the line, yes or no? Plus the error gives you the actual point. This is going to be the equation for a security return. Yes or no? No. Ri can be R1, R2, and then what? R3. 3 years I have Ri or not? I represents what? Number of years. R1, R2, R3. I'll be having 3 numbers using this equation. Respond yes or no. I ask a question. Then you expect a return. Expect a return is first year return, or second year return, or third year return, or average return. The expected return is what? Average return. That means when I say expected and I say Ri bar, that means what? Average return. Average is equal to alpha plus, because 18.93 plus 18.93 plus 18.93 divided by 3 is what? 18.93 only. It is not going to change. Yes or no? Plus beta into Rm bar. That is Ri is equal to alpha plus beta into Rm bar. Very simple. What is the return expression on the security? Alpha plus beta time the average market return gives you the expected return of the security. In this equation, one number is missing. What is that here? EA. Because when I expect, I don't expect an error. Simple logic. Somebody asks you, what did you expect? I expect to get 60 marks with error. Expectation cannot have error, yeah. Then later what you expect is correct or not, we can confirm with error. Are you following what I'm saying? But the expectation cannot have error. Are you following or not? This is a simple common sensical way of what? Understanding this particular equation, right or not? Other way is alpha plus beta Rm bar plus what? EI bar. EI bar is 0 because sigma EI is 0. The total of the error term should be what? 0. Its average should also be what? 0. Since EI bar is 0, simply expect the return of a security is equal to what? Alpha plus beta time RM bar. Everybody yes or no? Now, this is past. This is what? Future. Based on past, I regress the future. Are you fond of saying based on past, I extrapolate the future. To know about the security's future, I should know about the security's past. So, I believe that the past is going to continue. Always regression, we assume that the past is going to continue in the future when I extrapolate. Are you following what I am saying? So, now there are two equations, regression equation. One is Ri is equal to alpha plus beta Rm plus Ea. This is the equation for what return? Actual return. When I want an equation for a future return or expected return, tell me what the equation? Ri bar is equal to alpha plus beta Rm bar, error term will be what? Missing. So the average return of the security, expected return of the security is nothing but what? Alpha plus beta time, the expected return of the market portfolio gives you the expected return of the security. Respond, are you following? No. This can be used as a discount rate. The chapter name is what? Discount rate discovery. So many persons gave their own discount rate or not. What CML said, KE is equal to RF plus sigma P by sigma S into RM minus RM. 1%. So no, this is called as what? Capital market line. What is security market line? RF plus that is sigma S by sigma M into correlation of SMA into what? RM minus RM. It is called as what here? The SML. Yes or no? Like that. This is also another CML, characteristic market line, alpha plus beta RM bar. That is, I know the average return of the portfolio, yes or no, market portfolio. When the market portfolio is average return, either expected return of market portfolio, yes or no, my security should be giving me beta times expected return plus what? Alpha will be the expected return of the security. Is another way of finding out what? The return of the security. Everybody following what I am saying? Now, this only later developed into this equation. I don't want to give that link. It is going to be too much for you, not required also. So, first came this equation and then only came what? CAPM. CAPM is much more simplified. It is much more modified equation compared to what? Sham single index model. Both are given by what? Short only. Everybody, are you following what I am saying? So, these are all the different lines we have discussed. So, point number 1 is actual return will be having a error term, but the expected return will not be having what? Error term, because the error term average is what? 0. Here it is going to vanish. Is point number 1 I wanted to discuss. Yes or no? No. Can I go to the point number 2 or not? Next. See, return of a security. Return of a security is influenced by 4 factors. For example, JK limited share is expected to give what return? A question arises. Now, the return which I expect from the JK limited share depends on 4 things. Depends on what? 4 factors. Is in the formula. So what are 4 factors? One is what? Alpha, beta, RM, and EA. Yes or no? No. Beta and alpha are what? Constant. RM and EA are what? Variable. This depends on the correlation coefficient. Yes or no? The error term is depending upon how scattered the point is, and then also what? RM. So return of security is dependent on alpha, beta, RM, and then what? EA. Respond yes or no? No. Every variable will have 2 features. Any variable will have what? 2 features. It will be having a mean, it will be having a standard deviation. Any variable will be having how many features here? 2 features. Yeah, x should be having a x bar, it will be having a sigma x. So a variable having what? 2 features, namely what? Mean and then what? Standard deviation. Now, if you look at this, the mean is called as what? RM bar. The mean is called as what? RM bar. The standard deviation only they measure as what? Variance here. So what is the variance? It is sigma m square. It is called as what? EI bar, and this is going to be what? Sigma EI square. You all should know that EI bar is what? 0. It has only what? Variance. The error term has a mean of 0 and has got only what? Variance. In the second point, I just wanted to highlight. Everybody yes or no? I'll develop it to the third point. So now tell me, return of security depends on the following. First is what? alpha, second is what? Beta, third is what? RM, fourth is what? EI. Out of the four, what two are constants? Alpha, beta, what two are variables? EI. So the variable should be having a mean as well as what? Standard deviation. Mean of market formula is what? RM bar. Its standard deviation is what? Sigma M square. And EI bar is what? 0. And sigma EA squared is going to be called as unsystematic risk. Enna parade or not? So the beta times the sigma M squared is called as what? Systematic risk. And this is going to be called as what? Unsystematic risk. In the second point I just wanted to discuss. Can I proceed to the third point or not? No. See. What happens is, when you come to the portfolio risk formula, when you come to what? Portfolio risk formula, if you remember, the variance of a portfolio is equal to Wx beta x plus Wy beta y the whole square into sigma M square. It is what risk? Systematic risk plus what unsystematic risk? Wx square sigma Ex square plus Wy square sigma Ey square. That's all. I did not write 2 into Wx into Wy into sigma Ex into sigma Ey into correlation of Ex Ey. I did not write yes or no. Why the question arises? Can I proceed or not? No. Similarly, here also I did not write Wx beta Wx square beta x square plus Wy square beta square plus 2 into what? Wx Wy beta x beta y. I didn't write what? Correlation. So why the correlation term is missing everywhere is a question that needs to be answered. Yes or no? Further the chart gives you two answers. Okay. First of all, number one, there are two correlations that are there. Okay. One is I see the security X correlation with what? The market inside the beta. Beta has got inside it correlation between security and the market. Accepted? Beta X links correlation between what? Security and market, and beta Y indicates what? Correlation between what? Security and market. Yes or no? Now the question is, what happened to correlation between securities? First question. Second question is, sir, what happened to correlation between error and market? Two variables are there or not? See, there is an RI, is a variable. This is what? A variable. There's a correlation between RI and market. There's a correlation between what? Error and market. What I'm saying? Now the question is, sir, what happened to correlation between error and market? And what happened to correlation between what? The errors of two securities. All this question needs to be answered or not? Now, look at this. First of all, the correlation between market and error term is equal to 0. The correlation between what? Market and error term is equal to what? 0. If the error term is correlated with the market, it is not unsystematic, it is also systematic. Did you understand or not? No. That is a market, that is what? Error term. Error term is random. Error term is what? Random. If there is a correlation between error term and then what? Market, then in that case, that portion of the variance also stands explained through the market. Are you following what I'm saying? The issue now. So always error term and the market term correlation will be what? 0. I'll give us homework. In this problem you can just check it. We have what I can say, market return something like a 12.62, 20. I have 3 market terms or not. We have 3 market terms. We have what? 3 error terms, year 1, year 2 and year 3. For these two numbers, you try to calculate correlation. You try to calculate what? Correlation. You will know that after the calculation, the number will become 0. Number will become what? 0. Then only the error is free to be what? Uncorrelated to the market. Yes or no? If the error term is correlated to the market, then this cannot be called as what? Random error, because it is having a link to the market. It also forms part of a systematic risk. What is not systematic, what cannot be unexplained. When the market changes, how much the security changes, if a portion cannot be unexplained, that unexplained portion only called as what? Error. That unexplained portion has got no link to what? The market change. Hence the correlation between error and market should be what? 0. Is another observation. Everybody following or not? Now, that is number 1. Next. What happens to correlation between error of security X and what? Error of security Y. Okay. We have a portfolio now. Security X and then what? Security Y. Security X is having an error. Security Y is having what? Error term. These two errors will be having a correlation or not? Now, here Mathematically, they can have a correlation. They can have what? Correlation. Two securities, random error can have what? Correlation. But empirically, this you have to believe it, shot through various research. Empirical means what? Mathematics cannot be proved, but by collecting data for so many companies that can be what proved. Empirically, they also proved that correlation between two securities error term is also what? Zero. So two securities error is having what? Zero correlation, because what he extends by saying that if two securities error terms are what? Correlated. Then the unsystematic risk is what? Correlated. Then they will start to begin what? Portfolio, which becomes systematic. Are you understand what I am saying? So the error term random. Something is random. It should not be related to what? Any other thing. So the error term is neither correlated to market, neither is correlated to what? Another error term. So the error term is having uncorrelated number. Then only we can call as random. Something random means what? It should not be correlated to anything. That is why sigma Ex, sigma Ey, correlation of Ex, Ey is what? Zero. Hence, we don't have this term in what? Unsystematic risk. In unsystematic risk, correlation term will be absent. Like this, it has been framed. Are you following what I am saying? So now you are able to understand the variance of a portfolio or not? Tell me why the portfolio variance is not having two Wx, Ex, Wy, Ey, and then what? Correlation of Ex, Ey. The reason is what? The correlation between error term is going to be what? Zero. Since the two securities cannot be having a correlated random error. Everybody following not? That has been proved to the empirical study. These are some more observations one had made from the Sharpe single index model. With that completely the model has been discussed. Are you following not? Now, 3 points I discussed here. Point number 1, Ri is equal to what? Alpha plus beta Rm plus Ea. Ri bar, the expected rate of security Ri bar is equal to what? Alpha plus beta Rm bar. What is not that? Ei. You know the average of error term is 0. Number 2, 4 variables are that affects the security return. What are 4 variables here? Alpha, beta, Rm. Out of the 4, what are the constants? Alpha, beta. What are variables? Rm, Ea. Variable should be having 2 features. Every will be having a mean and then what is standard deviation. Rm mean is what? Rm bar is an average. And what standard deviation? Sigma m. The variance is what? Sigma m square. What is Ei bar is what? 0. Mean of error term is 0. But there exists what? Variance. It is Ei, sigma Ei square. This is called as what? Unsystematic. And beta term this is called as what? Systematic risk. Can I proceed or not? Now, third. Rm and Ea are 2 variables or not? So, will they have correlation or no correlation or no correlation? If they have a correlation, then it means that the error term is not random. It is also what? Systematic. We understand that in a regression equation, error term and the dependent variable, independent variable will be having what? No correlation. So, there is no correlation between the market return and then what? Error in the security return. The correlation should be 0. This is mathematically provable. You can go home and do for M and Ei the correlation calculation. What is correlation? Covariance of x and y divided by sigma x, sigma y. The covariance of market and error term divided by what? The standard deviation of the market and standard deviation of the error term will be giving what answer? 0 answer. We can check it later. Everybody following now? And finally, in a portfolio, security X will have an error, security Y will have what? Error. Between the 2 errors, will there be any correlation? Empirically, it is proved. Mathematically possible. Empirically, it is proved that what? There can be no correlation between error terms of 2 securities. If they say that if there exists correlation like that, then what happens here? They form a small system and create a systematic risk. Yes or no? Because how you suffer and how I suffer, if both having a correlation, then something common is affecting us. Yes or no? Now, you are also suffering, I am also suffering here due to CA Institute. You have to read more, I have to teach what? More. In that case, both are suffering. In that case, when you have a correlation suffering or not, the correlation is not random. It's due to what? There's a system there. Are you following what I'm saying? Your suffering, my suffering, unrelated only means the suffering can be random. Are you following what I'm saying? So logically, the theory extends that 2 error terms cannot have what? Any correlation. If they have, it is not random. It becomes what? Systematic only. Is what is a Sharpe single index conclusion. Everybody following or not? With this, we have completed discussion regarding the Sharpe single index model. This last 4 points I'll just dictate. Next problem is very simple. Formula may be big to by heart, but nothing more to discuss, because I also don't know to discuss. That formula is a very great derivation which we won't be doing it. We'll be having only the Computer software, you'll put the numbers into formula and then get what? Answer. That's a very important concept which is there in the study material also. Can I say? Now, let's write the notes for this. Write down some observations. Some observations from the short single index model. Please. Shh. Some observation from the short single index model. Some observation from the sharp single index model. RI, point number 1, right? RI, in bracket, right? Return of a security. RI, in bracket, right? Return of a security, bracket close, is equal to, return of a security is equal to alpha plus beta RM plus EI. Return of a security is equal to alpha plus beta RM plus EI. Alpha plus beta RM plus EI. Point number 2. Expect a return of a security. Expect a return of a security. Expect a return of a security is its average return. Expect a return of a security is its average return. Expect a return of a security is its average return. RI bar is equal to, the bar represents what? Average. RI bar is equal to alpha plus, tell me why I don't write alpha bar here? Alpha average is what? Alpha is a constant, no? RI bar is equal to alpha plus beta RM bar. RI bar is equal to alpha plus beta RM bar. Plus beta RM bar. Continue. In this, there is no error term. In this, there is no error term. Because the average of error term will be 0. In this, there is no error term because average of error term will be 0. Because average of error term will be 0. Since sigma EI, sigma here means what? Total. Ninge pariya sigma EI. Don't have stand deviation, sigma EI is equal to what? 0. Now total of error term is what? 0. You saw in one of the previous calculation, na? Because sigma EI is equal to 0. Sigma EI written like E, sigma, written on, sigma is equal to 0. The sigma is confusing me so much. Can I say? Next. Are you clearly understanding writing or not? Next. And I took Xerox of a student, yeah, okay. In the sigma, so much confusion is there in the notes. That's why I'm just dictating again. Are you following? Next. Point number 2 or 3? 3. Point number 3. A security return, please. A security return is influenced by. A security return is influenced by 4 input factors. A security return is influenced by 4 input factors. A security return is influenced by 4 input factors. Branch it into 4. What are 4 factors here? Alpha, beta, RM, EI. Alpha, beta, RM, and then EI. Now, how you say EI influences here? EI influences because of lack of correlation. If the correlation is perfect, then security is influenced only by what? 3 factors. Namely what? Alpha, beta, and then what? RM. There will be no what? EI. Unsystematic will not be there. Yes or no? Why that EI comes? Because of what? The lack of correlation only is having the 4th factor influencing as a company specific factor. Everybody, are you follow what I am saying? Now, in that, alpha, put that down here I can write. What is alpha? Constant. Alpha is a constant. It will not change. It is a constant number. All these are not. Alpha is constant. Beta is what? Constant. Is a constant slope. Beta is what? Constant. RM is what? Variable. RM is variable and EI is what? Variable. EI is variable. Can I proceed? Point number 3 or 4? 4. Any variable will have two features. Any variable will have two features. Any variable will have two features. Branch it into two. What are two features of variable here? Mean and then what? Standard deviation. Any variable will have two features, mean. Second branch is standard deviation or variance. We can represent, discuss either standard deviation or what? Variance. Nothing wrong in both. Mean or mean. Second branch is standard deviation or variance. Mean put a down back and write RM bar. Mean put down back and write RM bar and EI bar. Mean rate RM bar and then what? EI bar. EI bar in bracket right is 0. EI bar in bracket right is 0. So we have the mean only for market portfolio. We don't have for the error term. EI bar is 0. Go to the next branch. That is standard deviation, right? Sigma m square. I am writing variance now. Sigma m square. And it will be what? Sigma EI square. Sigma m square and sigma EI square. Sigma m square, sigma EI square. Point number 3 or 4? Point number 5. It can be statistically proved that correlation between market return and correlation between market return and the error term. It can be statistically proved that the correlation between market return and error term is 0. If correlation exists, it will not happen. If white crow exists, it is not there now, like that. If correlation exists, tell me, if white crow exists, then it is not a crow. Like that. If correlation exists, then the error is not. If correlation exists, then the error is not what? Random error. If correlation exists, please, then the error is not random error. If the correlation exists, then the error is not random error. It is influenced by what? Market. If correlation exists, then the error is not random error. It is influenced by market. The error is not random error. It is influenced by market. It becomes what? Systematic. It is influenced by market. It becomes systematic. Everybody following or not? Last point. Point number 6. It is empirically proved. There are two ways of proving something. One is through mathematics or statistics. Another is through the practical, showing that, see, in all this company, there is no correlation. One can prove what? Empirically. Okay, it is empirically proved that there is no correlation between error terms of two securities. It is empirically proved that there is no correlation between error terms of two securities. There is no correlation between error terms of two securities. That is why in unsystematic risk calculation of portfolio, the formula is, now can I write the formula? Wx square into what? Sigma Ex square. Wx square plus sigma Ex square. Next is what? Wy square into sigma Ey square. Now in portfolio, what are you going to do? Plus what? 2 into Wx into Wy into sigma Ex into sigma Ey into correlation of error of X, error of Y. 2 into Wx into Wy into sigma Ex into sigma Ey into correlation of what? Error of X, error of Y. Now this number strike and write as what? 0. Strike and write as what? Because the correlation in what? Two error terms is 0. Make it as what? 0. Therefore, unsystematic risk is equal to simply what? Wx square sigma Ex square plus Wy square sigma Ey square. Unsystematic risk is equal to Wx square sigma Ex square plus Wy square sigma Ey square plus Wy square sigma Ey square. Everybody, are you understanding and not? Now, the third component becomes 0 because the correlation is what? 0. That particular part of the formula vanishes. Okay. With this, we complete this area called as sharp single index model. Okay. Give the heading. Sharp optimum portfolio construction. This is the last thing we'll be doing it today. Sharp optimum portfolio construction. Again, the problem to be done is a study material problem. Okay, sharp optimum portfolio construction. Okay, see, in a share market, we have number of securities to invest. Suppose 30 or 40 popular shares may be trading. The question is, which shares I should buy, in what proportion I should buy. A question arises, yes or no? Now we are moving away from sharp single index model. I am going to go for a different area. Okay. In a stock market, suppose 10 securities are trading. All the 10 we need not invest. The money which we have need not be invested in what? All the 10. Out of all the 10, in which securities I should be putting my money? First issue. Number second issue is what? In those securities, how much proportion should be what? Invested. This is what Sharp tries to answer through a particular formula set called as Sharp Optimum Portfolio Proportion. How it is going to be done, we'll be discussing now. There are 4 or 5 steps in doing it. Here we don't go deep into the logic. You only see how the calculation should be done in this regard. It is one of the study material sums also. Can I proceed? Now, let's start with the writing of the steps and then start doing the problem. Okay, now. Okay, write down. Steps to construct optimum portfolio under Sharp index model. Steps to construct optimum portfolio under Sharp index model. Please. Step 1. Calculate reward to volatility ratio. Calculate reward to volatility ratio. Step 2. Arrange the security in the descending order of that ratio. Step 2. Arrange the security in the descending order of that ratio. Arrange the security in the descending order of that ratio. Arrange the security in the descending order of that ratio. Step 3. Calculate cutoff point. Step 3. Calculate cutoff point and identify the securities to be invested. Calculate cutoff point and identify the securities to be invested. And identify the securities to be invested. Calculate ZJ. Calculate ZJ. Calculate the portfolio proportions. Step 5. Calculate the portfolio proportion. calculate ZJ. Finally, calculate the portfolio proportions. Calculate the portfolio proportions. A formalized steps which has to be applied in the given problem to understand the solution. Okay, now in this we have to calculate cutoff point. We have to calculate what? ZJ. For those two, there should be formula or not? Write down. Next, cutoff point. Finish copying, huh? I've been dictating, yeah. Calculate ZJ. Calculate the portfolio proportions. Over. Finish copying, huh? Those are not copy, raise your hand. Shall I proceed? Now, next. Cutoff point. That is the formula for cutoff point. Please. He calls as C star. Okay, cutoff point. Please. That's the formula for cutoff point. Cutoff point is equal to, write it, please. There is nothing but what? Variance of market. Sigma squared, M means what? Variance of market into, please, variance of market into I is equal to 1 to N sigma, I is equal to 1 to N sigma Ri minus Rf into beta I divided by sigma Ei, sigma squared Ei, Ri minus Rf into beta I divided by sigma squared Ei. Don't talk, please. Divided by, don't worry, we'll do in the class itself, divided by 1 plus sigma squared M means what? Variance of market, variance of market into I is equal to 1 to N, I is equal to 1 to N beta I squared divided by sigma squared Ei. I is equal to 1 to N beta I squared divided by sigma squared Ei. We'll learn all this in simple table later. Just write the formula. Can I proceed or not? No. Rumba simple. Don't think too much. What is sigma squared M? Simple matters what? Variance of market. What is the first term? Variance of market into summation. You just understand that Ri minus Rf. That is what? Return of security minus risk-free return. Please. Ri minus Rf into beta of the security divided by what is sigma squared Ei? Unsystematic risk. Beta represents to some extent systematic risk, and this is going to be representing what? Unsystematic risk divided by 1 plus what is this here? Variance of market into beta square divided by unsystematic risk is the formula for cutoff point. We'll learn more with the numbers. Can I proceed or not? Next. Calculation of ZG. Calculation of ZG. Please. Calculation of ZG. ZJ is equal to beta I divided by sigma squared Ei. ZJ is equal to beta I divided by sigma squared Ei into Ri minus Rf divided by beta I into Ri minus Rf divided by beta I minus C star. Please. What's happening here? Okay, you copy it. I have been dictating. Those are back finished copying, Amma? Stop talking. Please. So I will do it. I have been paid for that. Kadapa. Okay, please. Okay, finished up. Write quickly. I cannot control them. Can I say no? Okay, please. Okay, now enough. Can I start or not? Now, see. No need to worry about all this. Let's go stage by stage. There are 5 steps. Understand that first. The objective is in the share market today, in which security I should invest and how much proportion of wealth should be invested is what Sharpe tries to say in this particular optimum portfolio proportions. Okay, understood the objective of the sum or not? So what Sharpe tries to say, in a share market, which security I should be investing, in how much proportion I should be investing. This can be done in how many steps? 5 steps. Stop talking. Okay. Step 1 is calculate reward to volatility ratio. Very simple. Reward is the return, volatility is the risk. What is reward? Reward is return and volatility is risk. The ratio is as follows. Reward to volatility ratio is return of a security minus risk-free return divided by beta. This is the ratio. Please don't talk. This ratio is called as what? Reward to volatility ratio. It's nothing great. Can I write beta minus 0 denominator? Is it right or not? Yes. RA minus RF divided by what? Beta. Can I write the formula right there like this? RA minus RF divided by what? Beta minus 0. Like this, let us understand. For taking no risk, I want risk-free return. By taking an incremental beta risk, I get what? RI. This is the incremental return the security gives. For taking this what? Incremental risk. It gives you how much return the security is giving me for every unit of risk taken. Is called, we call as what? Reward to volatility ratio. Respond. Are you following what I am saying? This is later called as trainer ratio in the mutual funds. Can I proceed? So what is reward to volatility ratio? RI minus RF. What RI minus RF? This is the premium the security is actually giving. That is the share of JK Limited is giving on an average 10% return. The risk return is how much percent? 6%. The share is giving me how much premium? 4%. For how much is taken? Beta is taken. So for every beta we know how much premium the security is giving. Everybody, yes or no? So tell me what is the ratio formula? RI minus RF divided by beta is called as reward to volatility ratio. Point number 1. Accept or not? Yes or no? Now, tell me, I have 2 securities, X limited, Y limited. X ratio is 5 times. Y ratio is what? 3 times. Which is better, X or Y? Security having higher reward to volatility ratio better, lower better? Security X is having that ratio of 5 and Y is having ratio of what? 3. Which is better? 5 better, 3 better? 5 better, because for every risk taken, it is giving me 5 return and next gives only what? 3 return. Higher the ratio, more the premium the security is giving to its investor. Inna parida not? Very simple. Listening. Listening or not? No. I'll give an example. Can I say it? No. LKG Mari, I have to prod you, please. Suppose risk-free return 6%. Yeah. There is a security X which gives 10%. Security Y which gives 11%. Both are having a beta of 2. What is beta of both? Yeah, 2. Is a beta for both X as well as what? Y. Same risk. Can I say? Tell me which is better, X or Y? Y. For the same beta, Y is giving what? 11. X is giving what? 10. How we express here? We say RI for X. What is RI? 10. What is risk-free? 6. What is the beta? 2. Is going to 6 minus 9 is how much? 4 by how many times here? 2 times. That is, for taking 2 beta, is giving what? 4 risk premium. For every beta, the premium is how much going to be? 2 times. For Y, it is 11 minus 6 divided by what? How many times here? 2.5. This is giving more premium for the beta. That gives me what? Less premium for the beta. In that case, the second is better than what? First. Now tell me, which is good security? Security having high reward to volatility or low reward to volatility. High reward for volatility is going to be what? Good security. He is not sharp says first. Yes or no? So what he says is, if a stock market is having 10 securities, for all the 10 securities, calculate this ratio and arrange them in what order? Descending order. And in what order here? Descending order. Because that having the highest ratio is what? First preference, and then go for what? Second preference, and so on. Arrange them in the descending order. Point number 1 over. Respond. Yes or no? Can go to the point number 2 or not? Next. So calculate reward to volatility ratio and arrange them in what? Descending order. Third, he asks you to calculate something called as cutoff point. For that, the formula has been given. From that, we know where to invest. Then calculate something called as ZJ. From that, we know proportion invest. All those I can tell you only after doing the problem now. Can I start with the problem or not? Now, let's take the next problem in the workbook. There is one of the study material sums also. Okay. Please. Okay, please take that problem. Stop talking, please. Find the cutoff point on optimal portfolio using the following data. Please. Security 1, 2, 3, 4, 5, 6, 7. There are 7 securities in the share market. It's a market with 7 shares. Okay, please. Mean return means what? Average return. We even call it as RI. What is average return? Call as what? RI. What is the average return? 19, 23, 11, 25, 13, 9 and then 14. Please participate. This is RI. It can also be called as what? Expected return. Excess return. What is the excess over the risk-free return? What is risk-free return given the question here? 5%. The security is expected to give 19. The risk-free is what? 5. What is excess over risk-free? 14. The security gives 23. Risk-free is what? 5. What is excess over risk-free? 18. Like that they found out RA minus RR, which short called as excess return. Is called as what? Excess return. Can I proceed or not? Now. They are also given you the beta. Either premium you are receiving for what? For giving the beta. The beta of the securities are 1, 1.5, 0.52, etc. The beta is given for the security. Please, can I proceed or not? Now, next is what? Unsystematic risk, which you call a sigma EA square. We know how to calculate it, right or not? So the question is given you the unsystematic risk. Make a small change, typing mistake. 6th security, make it as 50. Please make it as what? 50 in 6th security. 7th, make it as 30. Security 6, make it as 50, and 7 make it as 30. 6 is 50, 7 is what? 30. Okay. Now, excess return to beta. Excess return to what? Beta. Tell me what is this column? Tell me the formula for this column. RI minus RF divided by beta. That is what we call as reward to volatility ratio. Right or not? In sum of the sum, this should be calculated. The sum has been given. Now, everybody please tell me how I got this 14. I want an answer. How I got this 14? What is RI? 90 minus what is RF? 5. There is going to be what? 14. RI minus RF is 14 divided by what? Beta 1 gives you 14. Respond yes or no. I want one more number. Tell me what is RI minus RF? 80 divided by what? 1.5 gives you what? 12. Let's take the last RA minus RF is what? 9. What is beta? 1.5. Gives you what? 6. So most of the sums, even this should be calculated because it's going to be the first step. Yes or no? Some questions may give you only RA and then what? Risk free. We should do the other calculations. Everybody following or not? So these are all the details given. Now the market portfolio variance. The variance of market portfolio, how much is going to be? 10. Tell me what is this 10? Tell me it's going to be what? Sigma M square is the market portfolio variance. Are all the details given. Now the question is, will you invest in all the 7 shares? If not, in which share we are going to invest and how much to invest is the question that Sharp tries to understand. Are you following what I am saying? So this is a Sharp optimum portfolio construction. Nothing great we are going to learn. Only we are going to do and by heart it, that's all. The complex formula, I'll make it into a simple table for you to calculate it. Can I start or not? Now, first of all, answer me. How many steps are there? What are 5 steps? Reward to volatility ratio. Tell me the ratio. RI minus RF divided by beta. That's step number 1 we should do or need not do? Need not do. The question has given you straight away. Yes or no? No. Second step is what? Arrange the securities in the descending order. Second step we should do. Question has done. Question has done. Arrange the in what order? Descending order. Normally this also we should be doing it. Are you following what I am saying? The question has given you the reward to volatility ratio is also arranging it in what? Descending order. First 2 steps already completed by the question itself. Yes or no? Now we have to do only what? 3 more steps. What third step? Yeah. Calculation of cutoff point and select the security. Next is what? ZJ calculation. And the last step is what? Proportion. These are the last 3 steps. One should be doing it. Everybody, yes or no? Okay. Now, cutoff point formula, don't worry about that now. Let me put a table. From the table, we can just later put the numbers into the formula. Now, please help me out. Participate with me in doing the table calculation. Can we start or not? Now. I will do it and give you time to copy the table next. Can I start or not? First, tell me. Calculation of input data required to calculate what? Cutoff point. Okay, please everybody. These are all the column numbers. Okay. Security RI minus RF divided by beta. Can tell me what is its meaning? Reward to volatility ratio. Next is RI minus RF into beta divided by unsystematic risk. Next is sigma column 3. Next is beta squared divided by unsystematic risk. Sigma column 5. Okay, now we'll do it and then we can see the formula later why this is a input data. You tell me one by one. Name the securities. 1, 2, 3, 4, 5, 6 and 7 securities. The 7 shares in the stock market. Security 1, what is RI minus RF by beta? Last column, 14, 2, 12, 12, 10, 8, 8, 6. Can I put it or not? Okay, make a change. Okay, change it. Yeah, it's going to be what? 6. Okay, please. Shh. I'll change it later. Can I put it or not? Now, please. Shh. RI minus RF into beta divided by unsystematic risk. I'll write it in the sheet to understand what is being done. Please, don't talk. RI minus RF into beta divided by what risk? Unsystematic risk is sigma EI squared. No? If you see in the cutoff point formula that comes under numerator sigma. Formula, you have written in the notebook or not? What the formula? Numerator, it is variance of market into, solli, what is numerator? Sigma M squared into sigma I is equal to 1 to N. What is that? RI minus RF into beta divided by sigma EA squared. This is what I am trying to calculate here. Everybody, yes or no? This is the third column. Respond, yes or no? No. You should apply your mind, do and tell me. Take the calculator, take the calculator. First. Shh. Stop, please. Shh. Everybody. Now, I don't want indiscipline. Please. Please. Take the calculator. Security 1. What is RI minus RF? So, what is RI minus RF? 14. Into beta is what? 1. divided by what unsystematic risk? 20. Enna right or not? Yeah, very simple. Yeah. Third column into fourth column divided by what? Fifth column. It is there in the question, yes or no? Tell me 14 into 1 divided by what? 20. What is the number here? 0.7. Now, you tell me for two more securities, then I'll put for everything. Please don't talk. Stop. When I ask, tell me. Mudilappa. Can I proceed or not? No. Okay, please. You tell me. For security 2, what is RI minus RF? Into what is beta? What unsystematic is divided by 30. 18 into 1.5 divided by 30. We can tell it later. Okay, are you understanding it or not? Please. For security 7, tell me what it is. 9 into 1.5 divided by 30. I hope you are all following or not. So did you understand how the numbers has been calculated? No. Please tell me now the number. For security 2, tell me 18 into 1.5 divided by 30. What's the number? 0.9. Next, 6 into, this is what I don't want. Tell me when I ask, can I proceed? Now you tell me along with me. 6 into 0.5 divided by 10. What the number here? 0.3. Next number, what? 20 into 2 divided by 40 is what? 1. Next is what? 8 into 1 divided by 20 gives you 0.4. Next is what? 4 into 0.5 divided by 50. You change the number or not? What the number is going to be? 0.04. 9 into 1.5 divided by 30 gives you 0.45. This is the column 3. What is column 3 heading? Tell me. Ri minus Rf into beta divided by unsystematic risk. By heart or not? No. Next is column 4 is sigma column 3. Column 4 is what? Cumulative column 3. First is what? 0.7 plus 0.9 gives you 1.6 into 0.3 gives you 1.9 into 1 2.9 3.3 3.34 3.79 is the column 4. Respond is or no? Okay. Column 5 you come to denominator. Denominator have what? 1 plus variance of market into sigma. Note about here. 1 plus variance of market into what? Sigma. I is equal to 1 to n. Beta squared divided by what? Unsystematic risk. No. I calculate beta squared by unsystematic risk. Tell me for first security you tell and then we put. Well, first security is what? 1 square divided by 20. Security 2. 1.5 square divided by 30. Security 3, 0.5 square divided by 10 and so on. Respond, are you following up? No. I now calculate here. Beta square divided by unsystematic risk. So look, first security, 1 square divided by 20 is what? 0.05. Please. 1.5 square divided by 30. 1.5 in 1 how much going to be? 0.075. 0.5 square divided by 10. What is the number? 0.025. 2 square divided by 40 gives you what? 0.10. And then 1 square divided by 20 gives you 0.05. 0.5 square divided by 50. What's the number? 0.005. 1.5 square divided by 30 gives you 0.075. Respond yes or no? No. Column 6 is sigma column 5. What is sigma column 5? 0.05, 0.125, 0.150, 0.250, 0.300, 0.305, 0.380 is what is the table required to calculate cutoff fund. Everybody following or not? Please copy this before you go for the next one. Please copy this quickly. Here question number 41. Please. Okay, don't talk. Copy fast. Soumya and I will come. Stop talking. Stop talking. Finish copying up. Stop talking, please. Those who have not copied, raise your hand. Please, quickly. Do it quickly. Okay, now listen here, please. Shh. Now, how many steps are there for this optimum construction? 5 steps. Listen, can I start? Now. Step 1 is calculate Ri minus Rf divided by beta, which the question has given you, not an issue. Step 2 is what? Arrange the security in the descending order. That too has been done by what? Question. I think when you have copied this, 8 has been made as 6. No, no problem. Please. Shh. Step number 3, how to calculate Cj for that required input data. It or not now. Please. Let us know by heart the formula for Cg. Okay. Now, so C star. Please don't talk. Cutoff point is equal to, tell me the formula. Look at the notebook, tell me the formula. Sigma m squared into sigma I is equal to 1 to n into what? Ri minus Rf into beta divided by sigma ei squared whole divided by 1 plus sigma m squared into sigma I is equal to 1 to n. Next is what? Beta I squared divided by sigma ei squared. This is the formula. Respond yes or no? No. This, no need to worry about this. All numbers have been already calculated. Now, can I write the formula simply? C star is equal to, what is sigma m squared? Variance of market. Variance of market into sigma I is equal to 1 to n Ra minus Rf divided by what? Beta divided by sigma Ea square is nothing but our sigma column 3 with nothing but what? Column 4. I simplify it. Variance of market into what? Column 4 divided by, tell me, 1 plus, once again what? variance of market into what? Column 6 is the answer. Everybody yes or no? Now tell me the formula now. Now tell me the formula. C star is equal to what? Variance of market into column 4 divided by what? 1 plus variance of market into column 6. Tell me once again what is the formula? Variance of market into column 4 divided by 1 plus variance of market into column 6. Now we should know the 6 columns or not. Tell me one by one. First column is what? Don't look at the slide. First column is what? Security. Second column is what? RI minus RF divided by beta. Third column is what? RI minus RF into beta divided by unsystematic risk. Fourth column is what? Sigma column 3. Fifth column is what? Beta square divided by unsystematic risk. Say column 6 is what? Sigma column 5. Now you are having the data for calculating cutoff point or not? Yes or no? Now the next step is to calculate what? Cutoff point. Can we proceed together? Write down next step. Step 2, cutoff point. I'll leave you another 10 minutes quickly. Please write step 2, cutoff point. Please, I have to complete this sum. Yeah, cooperate. Step 2, cutoff point. Write the formula. Cutoff point is equal to, we made this much more simpler. Okay, cutoff point is equal to variance of market into, cutoff point is equal to variance of market into column 4, variance of market into column 4 divided by 1 plus variance of market into column 6. Variance of market into column 4 divided by 1 plus variance of market into column 6. 1 plus variance of market into column 6. In the notebook only you have column 4 and column 6. I have in the previous slide. I require your help for computation. Can I proceed or not? Now, please. Variance of market, question is given. What is variance of market? 10. It is given as what? 10. Okay. Can I proceed? Now, let us do it together. Security, computation, cutoff point. Security, computation, and then cutoff point. Security, computation, cutoff point. Security, computation, and cutoff point. Okay, let's start one by one. Security 1. Security 1. 1 or 2 securities will understand the computation, remaining can just copy it. Okay, security 1. Now, don't write, tell me, what is variance of market? Tell me. 10. Into what is column 4 for security 1? 0.7. 10 into 0.7 divided by 1 plus, what is variance of the market? 10 into what is column 6? 0.05. Ennappa, right or not? So it is 10 into 0.7, variance of security into column 4 divided by 1 plus, variance of market into what? 0.5. Please copy this now. I think it is 4.67. Then check the calculations. 4.67. 10 into 0.7 divided by 1 plus 10 into 0.05. 4.67. Please. 4.67. Okay. Everybody let us write together. Security 2. You have to tell me, then we'll put on the slide. Please tell me, what is variance of market? 10 into, what is column 4 for security? 1.6. 10 into 1.6, numerator over 10 into 1.6 divided by denominator 1 plus, what is the variance of the market? 10 into what is column 6? 0.125. 10 into 1.6 divided by 1 plus 10 into 0.125. 1 plus 10 into 0.125. Tell me the cutoff point, 7.11. Cutoff point 7.11. Cutoff point is 7.11. Now, stop writing. I want a confirmation from my side for at least third security, and then let's put the remaining slide. Now, you tell me for third security, what into what? I don't have numbers. 10 into 1. 10 into 1.9 divided by 1 plus 10 into what is column 6? 0.15. That gives you 7.6. That gives you 7.6. Like that, I have calculated for the remaining securities. Please copy this quickly. Please copy this quickly. Please. I am going to file a police complaint with Arvind Kejriwal. The faculties are being ragged on. Stop talking. Stop talking. Those not copy, raise your hand. Please, fast. Shh. Stop talking. Please. Shh. Can I proceed, Abba? No. If you see here, stop talking. This cutoff point is something similar to utility. I am not saying the full logic, just the overall logic. Cutoff point is something similar to utility we had in one of the Markowitz sum. Yes or no? For the utility function here, it is a half into adjustment rate squared. We have it or not? Same, it is a cutoff point here, something similar to utility. See, the cutoff point was increasing from 4.67 to 7.11 when I add security 2 inside the portfolio. Yes or no? Security 1 is going to be surely there. Other top rank security. Yes or no? We add security 2, it increases my utility. Security 3 increases what? Further. Security 4 increases what? Further. Security 5, what happens? The utility drops. So what he says is, in the 7 security market, I will not invest in 5, 6 and 7. I invest only up to what? Security 4. So now I know that my portfolio consists of what? 4 security, 1, 2, 3 and 4. Everybody following what I am saying? So write down next step. The portfolio should consist of only securities 1, 2, 3 and 4. The portfolio should consist of only securities 1, 2, 3 and 4. Should consist of only securities 1, 2, 3 and 4. Because beyond that, the utility, in bracket write what? Cutoff point. Beyond that, the utility, in bracket write cutoff point reduces. Beyond that, the utility, that is cutoff point, reduces. Okay, everybody yes or no? Now, I am going to invest in security 7 up, 6 no, I want to invest only in what? 1, 2, 3, 4. Equal amount of? No, in a given proportion, for that only ZJ is going to be what? Helpful. The last but one step, calculation of ZG. Please, step 3, calculation of ZG. I want to copy fast, calculation of ZG. We have written already the formula for ZJ, written on. Tell me what is ZJ formula? Beta by unsystematic risk. Beta by unsystematic risk into what? Column 2 minus C star. Cutoff point. Beta by unsystematic risk into column 2 minus cutoff point. Column 2 minus cutoff point. Everybody, are you following what I am saying? We see the formula beta by sigma EA square. Minus Ri minus Rf by beta minus C star is the formula, na? That's what has been written here. Can I proceed or not? No. Security computation is a G. Security computation is a G. Security 1, look at the workbook. Beta by unsystematic risk is what? 1 by 20. Now question about here. What is beta of security 1? 1. Unsystematic risk 20 into 14 minus for the cutoff point 8.29. That is my ultimate utility. S on a point of tangency 14 minus 8.29. The number is going to be 0.2855. Check the number. Right or not? 0.2855. Please. 0.2855. I want a confirmation. You tell me for the second, please. All of you tell me for the second. Beta by unsystematic rest. What by what? 1.5 divided by 30 into what is say column 2 23 minus 8 point. That is it's going to be 12 minus 8.29. 12 minus 8 point. That's column 2 in our computation. Sorry, 12 minus 8.29. 12 minus 8.29. The number is 0.1855. Please, 0.1855. 0.1855. 3. Security 3. Beta by unsystematic rest. Tell me what is beta by unsystematic rest? 0.5 divided by 10 into 0.5 by 10 into 12 minus 8.29. 12 minus 8.29. 0.1855. 0.1855. Step 4. Or security 4. Sorry, security 4. Beta by unsystematic rest. 2 divided by 40 into 2 divided by 40 into 10 minus 8.29. 2 divided by 40 into 10 minus 8.29. That gives you 0.0855. That gives you 0.0855. If I total it, the total of ZJ will be 0.742. ZJ total is 0.742. ZJ total is 0.742. 0.742. Last step. Now, 0.2855 out of 0.742 is a proportion in what? Security X and so on. Can I proceed? Now, last step, optimum portfolio proportion. The last step is optimum portfolio proportion. Stop talking. Optimum portfolio proportion. Security, computation, proportion. Security, computation, proportion. Okay. Security 1. Security 1. What is ZJ of security 1? Tell me how much is it? 0.2855 divided by what? 0.742. 0.2855 divided by 0.742. Tell me what is the proportion? 38.48. Getting the number or not? 0.2855 divided by 0.742 gives you 38.48. Okay. Security 2, tell me what divided by what? 0.1855 divided by 0.742. 25%. 0.1855 divided by 0.742 is equal to 25%. Is equal to 25%. Next. Security 3, 0.1855 divided by 0.742, 25%. Please, 25%. 0.0855 by 0.742, it is 11.52%. 11.52%. The total should be 100%. Total should be 100%. 1 minute, please. What Sharp says is that in the 7 security stock market, we invest only in what? Security 1, 2, 3 and 4. Because up to that only utility cutoff point was increasing. 1 minute. How much you invest in these 4? Invest 38% of your wealth in security 1, 25 in what? 2, 1, 3 and 11.52% in 4. Stop. Don't back. I'll close the door. Please report. Last. Now, tell me. 5 steps in optimum construction by heart it. Step number 1 is what? Reward to volatility ratio. What the ratio? Ri minus Rf divided by beta. Number 2 is what? Arrange in the descending order of that ratio. Step 3 is what? Cutoff point. Tell me the formula for cutoff point. Variance of market into column 4 divided by 1 plus variance of market into column 6. Tell me what is column 1, 2, 3, 4, 5, 6. Column 1 is what? Security. Column 2 is what? Ri minus Rf by beta. Column 3 is what? Ri minus Rf into beta divided by unsystematic rest. Column 4 is what? Sigma column 3. Column 5 is what? Beta square divided by unsystematic rest. Column 6 is? That is sigma column 5. Then compute Cj. Cj will be increasing and then begins to what? Decrease. Highest Cj should be taken. Those securities should be invested. Proportion through what? Zj. What is Zj formula? Beta by unsystematic rest into that Ra minus Rf by beta into C star. That gives you Zj. Proportion can be found out. Respond yes or no. Next class will start with the arbitrage pricing theory. Okay.
Thank you friends. OMSAI Bhojanapalli.